how to avoid or minimize extra tax from the new higher capital gains tax. So most of you may have heard that we just had a new budget here in Canada and increased the taxes on capital gains. So what we're going to talk about today is, what is the new higher capital gains tax? Who's affected? Why is it mainly a real estate tax? How to avoid or minimize the high capital gains tax is good ways to avoid it. Is investing inside your corporation still worthwhile? Will a higher exemption for small business help? Are rental properties or cottages still profitable? Why are only 50% or 67% of capital gains taxed in the first place instead of all gains? There's three nasty aspects of this new tax that bug me. I'm going to tell you what they are. Why do they say that only 0.13% of Canadians are affected? And will this actually hurt the economy? All right, so first of all, what is the new higher capital gains tax? It's in the budget 24, increased the inclusion rate. Now, being included usually sounds like a good thing. In this case, it's not. So what it did is, so now 67%, 2/3 of capital gains are going to be taxed instead of 50%. Okay? And now for people, for individuals, there is an exemption up to $250,000 a year that are still taxed at 50%, and it's the gains above that. For corporations, it's all gains, all capital gains. This is effective June 2025 of this year, 2024. So we only got 2 months notice for this thing, which is not much. And it's a big increase. Like, it's a 34% increase from 50 to 67. So it's not insignificant here. All right, so now who's affected by this? I've seen the full finances of thousands of people, and I can just tell you who's actually going to pay this kind of thing. We do their tax returns as well. So first of all, the biggest group are going to be people that own rental properties. Okay, so the number of Canadians is, from what I can gather, it's about 11% of Canadians, and it's about 4.4 million people. And so, they have a rental property, and so at some point they'll sell it and have a big capital gain. They'll get affected. Cottages, about 10% of Canadians have a cottage that would be affected by this, and so about 4 million. Another one is deaths. So you can avoid this until you die, but then it's declared that everything is sold on that day. So if it could be a rental property or cottage that you hold till then, or it could be you have other investments, and that's so probably another 2% of people are going to get nailed on their estate. That's about 800,000, let's say. Small businesses with investments. Now, only a third or less of small businesses invest inside their corporation, even that's what their tax advisors and we recommend generally, their accountants. But let's say that 1% do that, and that's about 400,000. There's professionals with corporations. Now, the biggest group here are doctors, but there's all kinds of different professionals, accountants, and usually not lawyers, but other kinds of professionals that have corporations. So, and IT people. So that's about, let's say, 1% of people, so about 400,000. It's also going to be employees with stock options. Now, the biggest ones here are IT. I see that quite a bit in IT. So it could be, people that work for Microsoft and Amazon, the big companies, or even a lot of smaller IT companies now are, if you're smaller and you're building, you don't have a lot of money yet, so you hire people with some smart IT people for a lower salary, but give them stock options. And those people are going to get nailed on it too. And this would include people working on AI now. There's a lot of them are going to be affected. So I think that's about 2% of Canadians. Let's say about 800,000. And the last group is people leaving Canada. Now here it's hard to get a number on these. I'm estimating about 3%, let's say 1.2 million people. But like from 2000 to 2010, there were lots of news articles about the brain drain, and all the smart people are leaving Canada, and it was in the news constantly. And now it's just not mentioned anymore. It's hard to get any numbers on that. Now, anecdotally, I believe it's more now than it was back then, but really hard to say. Okay, so you add all these up, it's about 25% of Canadians will get affected somewhere over their life. About 11 million people is my best estimate. Now, these numbers, it's hard to get accurate numbers, so these are all just my best estimate, but that's what I kind of think will be affected by this. Now, as you see, it's mainly a real estate tax. So the biggest two, rental properties and cottages are, probably 20% or more of Canadians, just those two. That's the bulk of who are going to get nailed with this. And the reason is you can't sell a property bit by bit. You sell as one big gain, and that's why they tend to get nailed on it. So now I'll give you this example. I think this is the classic. The people that are going to be most taxed by this And we got clients like this. I call him Vinny the tradesperson. So this guy works in construction all his life, makes like 50,000 a year. But when he was young, he moved to a new house and kept the old house as a rental property and kept it for 40 years. And now he's going to sell it as $1 million profit. So that's the year he's going to get hit by this higher capital gains tax. So that's the year he's part of the wealthy in Canada. He's considered one of the top 1%. And he's the people that we're taxing. And that's the norm. That's the bulk of them. So it's mostly middle class property owners that are mainly going to be taxed by this thing. So now what about equity stock market portfolios? We call them equities because you need equity in the company. So but what about them? So they're mostly not going to be affected because, first of all, a lot of that's in registered accounts, RSPs and TFSAs, so it's not affected anyway. There's a tendency to hold a lot of those for years, like especially people that have managed portfolios like mutual funds or ETFs. They tend, if you've got a manager or an index, you tend to hold those for many years, so you don't trigger it a lot in capital gains. The other thing is that, so we talked a lot about self-made dividends. I had a bunch of videos on that, and that's what we recommend for our clients. So what happens is when you've got investments, you're just mostly just investing for growth, and it just grows over the years. And then when you retire, you're just taking cash flow based on what you need for your lifestyle, but you're selling it bit by bit. And then it's not the full amount that you take out that's capital, that's taxable. It's only the gain portion of it, and now it's only 2/3 of that portion. So that's why, self-made dividends are far more tax efficient than, dividends or other kinds of income. And you're doing it bit by bit, so that's why you're really not affected. And I'll give you a couple examples. We got a client with $7 million portfolio and a rental property. Rental property is not extravagant, it's a semi-detached, but they're going to be nailed on the rental property, but not on the 7 million stock market portfolio. And we got other clients with more than 10 million investments, retired living on 500,000 a year. Now this would be fairly wealthy, however you would define it, right? 10, 15 million of investments, 500,000 a year of income. But what happens is part of that income is pensions and RSPs and stuff, and then part of it is from most of it's from the investments. But you take an amount, and you're taking these self-made dividends, and the amount that you get it's only the gain portion. So if you take 400,000 or 500,000 out, well, quite a bit of that was what you originally put in. So let's say half of it, and the other half is the gain. So that's maybe 200 or 250,000 of gains. But you split it between spouses, so they have like a little over 100,000 each. So even these people with 10 or 15 million of investments and 500,000 a year of income, in most years, nowhere close to the 250,000, so they're probably not going to be affected. It's just Vinny the tradesperson that's going to get nailed on this. It's funny how this all works. All right, so now how do we avoid this higher capital gains tax entirely, or at least minimize it? There's two basic ways to avoid it. Number one, sell before June 25th, and then you just get the 50% rate of today. The other one is do nothing and just keep holding your property for longer. So if you don't sell, you don't pay this tax. It's only when you sell that you pay it. All right? So generally, long-term investors should probably just do nothing. Just do nothing and just keep going as you are, and don't sell too much, and hold your investments maybe longer than you would otherwise. So the other part of it is there's a good chance this is reversed in 2 years by a government that's actually trying to grow the economy. So it's probably going to be gone anyway. So now, out of these two methods, sell before June 25th or just keep holding, do nothing, which is best? And what it comes down to is, if you sell now, you pay 50% tax, and if you sell later on, you'd pay 67% tax, so in the future. But would you rather pay 50% today or 67% in the future? And the answer is, well, it depends on how far in the future that is. So the way to look at it is look at how long would it take the investment that you have in question to grow from $50 to $67, and that's what gives you your answer. So real estate, typically grows 5 or 6% a year. So let's say it would take about 5 years to grow that amount. Stocks, let's say they average 10% a year. It's about 3.5 years. So the answer is, if you would sell this investment anyway in 3 years or less with stocks, or 5 years or less for real estate, then it's better to try to sell it now if you can. If you're planning to hold it longer term, then do nothing and just hold it longer term. So best advice, just hold your long-term investments. In fact, consider holding them even longer than you were thinking otherwise. Call it the lock-in effect, because you can avoid this entirely by just not selling anything, especially if this gets reversed. in 2 or 3 years. Then what you do is you should sell investments, so stock market investments. You should sell the ones that you would sell anyway in the next 3 years, or maybe worth selling now. Although if it's personal, you could stay within the 250,000, so you don't have to really worry anyway if you're under that amount. And then real estate is where it's maybe more worthwhile, but you know what? You can't really sell within. If you're only given 2 months, and if you got a rental property, you got to have the tenant move out and get it ready and sell it and have possession date before June 25th. It's just not going to happen. So it's, you don't really have that option. Now, is investing inside the corporation still worthwhile? So this has been something that's been commonly done, and it's something that most accountants recommend, and we recommend as well. So for small business people and professionals and doctors and IT people, so when you have a small business, what you do is you make money in the business, and then you only take out what you need for your lifestyle and you invest inside the business. Now, this is instead of RSPs or TFSAs or anything. This is your main retirement portfolio. Okay, so that's what we've been recommending. And now the question is it still worthwhile, because this is your main retirement portfolio and it's now going to be taxed more highly. That's what doctors are all worried about. Probably half or more of doctors are doing this, and now we're just attacking their retirement portfolio. But is it still worthwhile? And the answer is yes. And because there's a tax deferral, it's not a tax savings, but there's a tax deferral that's pretty big. So here's how it works. So you make money inside your company and you pay 12% the small business tax rate on the first 500,000. You pay 12% tax on it, and then when you take it out, at whatever point you take it out, you're going to pay either dividend or salary on it. And there's, tax is a bit complicated, but let's say you're going to pay about 31% more tax at that point instead of 43%. So if you're just getting salary, you'd pay 43% tax, but now it's because it's in the company, you pay the 12% tax and the 31% later when you take it out. So on your retirement portfolio, you pay 12% now. The other 31% is money that still stays invested. You're going to pay that tax later on. It's kind of like the RSP tax deferral, except somewhat different, but it's big enough that even with a higher capital gains rate, it's still worth doing, we think, for most people. So for people with small business, with corporations, here's our views on the whole thing. So first of all, investing inside the corporation, yes, it's still worthwhile. Number two, dividends are still better than salary. And the main reason is because you avoid paying into CPP. Self-employed have to pay double, and it's a pretty low rate of return, like 2% a year. So dividends are still better than salary. Now, the one change is it's now worthwhile to maximize your RSP. So now, if you pay yourself dividends, you don't get any new RSP room anyway. But, we got clients that have a small business and still had RSP from when they were an employee in the past. They still got RSP room. So, but up till now, we've been saying, don't worry about it. Just invest inside your corporation. That's what you should do. But now, because of this rule, and it's taxed a bit more highly there, it makes it worthwhile. So you pay yourself an extra dividend over and above what you normally do. Put that money into RSP. Your RSP deduction is going to be a net savings, because your RSP deduction is more than the tax on that dividend. Okay? But then, you're going to pay more tax down the road because the RSP is fully taxed when you eventually take it out. Well, you don't pay full tax on the investments inside the corporation, but because it's now 67% instead of 50%, that much makes the difference that we think it's now worthwhile to maximize your RSP when it wasn't before. Okay, now will the higher exemption for small businesses help? So what is part of this is, so there is a capital gains exemption on the sale of small business shares. It was increased from just over $1 million to $1.25 million. And so the idea was that we're trying to, attack the rich, but not the small businesses that are, the lifeblood of our economy. So is this going to help? And the truth is, I don't think so, because I don't actually think this is going to have much of an effect. And the reason is because it's actually rarely used. And that's probably surprising for you, because if you think, let's say, most small businesses, it's a family owned, the husband and wife own it, and so when they sell it, they can make $1.25 million tax free each. So combined, it's $2.5 million tax free they can get. So that sounds awesome, right? But the truth is, it's actually rarely used. And the reason is, when you sell a business, there's two ways to sell. You can sell the assets, or you can sell the shares. Now, if you sell the assets, then that's better for the buyer. If you sell the shares, it's better for the seller, because you get this $1.25 million exemption. All right. But then the buyer, If they buy the assets, they can claim it as goodwill, they can claim depreciation on it, so they deduct it over time. If they buy the shares, they get no deduction at all. So if you sell the shares of your business, you're going to have to sell the business for somewhat less because it's less favorable for the buyer. Now, the way you get the overall best deal is you look at, how do you pay the least tax total between the buyer and seller? And that's where the best, overall offer is going to be for both. And in most cases, you pay less total tax by buying the assets and not the shares. So in most cases, this tax-free gain is not used anyway. Now, are rentals properties or cottages still profitable? And the reason I raise this up is because, most of the growth of properties is inflation, and yet now it's 2/3 of it is 67% is going to be taxed. So I'll give you an example. So, a simple one is real estate the last while has been growing by, 6% a year, but inflation's been 3.5%. So more than half the growth is taxable, and yet 67% of the growth, of all the growth, is taxed. So more than half the growth is inflation, and yet now 2/3 of it is going to be taxed. So let's look at the numbers. Let's say you own a property for 25 years, it quadruples in value. So you bought it for $250,000, it's now worth $1 million. Okay? Now, so that's 6% growth. That's kind of what 6% would do. Now, inflation's averaged 3.5%, so you need $600,000 today to buy what the $250,000 bought back then. So you gained $750,000, but $350 of that $750 was just inflation. So now when you sell, the tax is going to be, here's how much tax you pay. Well, you made a capital gain of $750,000. It's 67% inclusion, and you pay 53.5% tax on it. So it's $270,000 tax. So overall, you grew $750,000 in value, but $350,000 of that was just inflation, so it wasn't a gain in wealth, and $270,000 was tax. So you're actually only up $130,000, and that's 1.7% per year after tax. So that's a pretty low return. So yes, it's still profitable, but that's not a very big return, especially if it's a lot of work to manage a rental property. So now before, you paid, with 50% inclusion, you paid $200,000 tax instead of $270. So and then the overall rate of return was 2.4 instead of 1.7 after tax. So it's 30% lower net profit from this. So it's pretty significant, but it's still profitable overall if you willing to do the work. Now, the overall profit on rental properties is a bit more than that, because so generally what I see is the net cash rent paying expenses is generally a break even in most cases. There's cases, like we see now, like for example, condos in Toronto, people like to buy them as rental properties, but they're bad because most of them are paying $500 or $1,000 a month out of their pocket. So they're negative cash flow, but generally they're about even. So you're not really making anything on that until your mortgage gets much smaller. But, like they say, the tenant is paying your mortgage, so it does pay it off over time. So let's say in this example, you bought the property for $250,000. You originally took a $200,000 mortgage, put $50,000 down. So that's paid off. And that has, when you work it out, that adds about 2.4% per year to your return. So you made 1.7% on the growth, 2.4% on the mortgage. So you made about 4.1% is what you made after tax by owning your property. Now, that's a lot less than the stock market. Still, profitable. But, now we have this tax that's mainly a tax on real estate, and it's dragged this down to 4.1%. And, real estate has already had a much lower return than the stock market. And, I have a chart here I can show you that's, this is from 1975, the average house price in Toronto. This is real estate in Toronto, which has been a fairly good growth. 75,000 up, now it's just over $1 million. But that same 75,000, if it was in the stock market, you'd have between 4 and 8 million, depending on if you invested globally or in Canada or in the US. So real estate is much lower growth anyway, and now it's got this tax mainly on real estate. So now, why are only 50% or 67% of capital gains taxed anyway? Like, why in the first place it's only partly taxed instead of having all gains taxed? So other income is fully taxed, but like interest and dividends, why not capital gains? And the reason is because it's encouraging investment. So First of all, let's look at the history of it. So, first of all, there was no capital gains tax before 1972. It was brought in 72. The inclusion rate was 50%. And then in 88, it was increased to 67%. That was actually Brian Mulroney. But it was part of a comprehensive tax changes, which had some other reductions for wealthier people. So they raised that to kind of offset. And then it was brought up to 75% in 1990 until 2000. Then 2001, it was brought back down to 50%. It was actually the Liberal government that did it. And they kind of realized that having this higher tax was dragging down the economy. That was, remember, so we have the tech boom going on at that time, and see all the stuff's happening in the States, and we're missing out on all the growth. And so we could see how much it was affecting our economy, and we could see that the higher inclusion rate didn't work, and, brought it back down to 50%, and it's been there ever since up until now. So now the reason we only tax part of it is because it encourages investment. And, like lots of studies have shown this, when you drag down investment, then it drags down the whole economy. So, and, I think the loss of the economic growth is probably, like economic growth brings in more tax overall. And I suspect that the overall growth, the tax on the overall growth is going to be larger than any tax they gain on this particular from this particular tax. And also, starting a new business, I started a business, a small business. I've seen lots of people that do it. Like starting a business and running a business is hard. It's a ton of work. It's difficult. It's risky. It's, most people are just not cut out for doing it. And the stat is, only 5%, 95% of small businesses go bankrupt in the first 5 years. Like it's really hard. And so we want to try to encourage people to do it, because that's where the growth, where all the job growth is coming from. Investment creates growth. So now the other reason that it's only partly taxed is because much of the growth, as is capital gains. So it's not really an increase in wealth. So it's if more than half of your growth is inflation, like on real estate, but you have to pay basically all of that in tax, then it's kind of really wipes out the advantage of having these investments in the first place. Now, there's three nasty aspects of this new tax that kind of really bug me. And first one is that it's a retroactive tax. So this is shocking. So it taxes gains in the past. So if you got a cottage or rental property 40 years ago and you sell it, and next year, you got to pay the 67% tax on all the 40 years of growth, not just from here forward. It's all tax in the past as well. So it's all tax on investments that you own today. It's from when you bought them. So now what they should have, just to be fair, it's a new tax. It should only be on, effect from here on in. And what they should have is an election that you could say, okay, I'm going to claim the gains up till now at 50%. Give me that option without selling it. Just let me claim the gains, and I'll pay the higher tax from now on later. And if they did that, they'd actually get a one-time, tax hit from this. And there's precedent for this, that because back in the 90s, there used to be a $100,000 lifetime capital gains exemption, back then. So every person could make up $100,000 of capital gains over their life, no tax. And when they got rid of that, they allowed you to claim capital gains up to then, which were tax-free. So, and that was just file an election is all you had to do with it, show the fair market value. And that would be fair to do that here. The other thing that is really kind of nasty is that it's only 2 months to do this, and it's not enough time for people to plan it. Accountants are super busy, and it's, creating all this panic. So, and it is kind of disingenuous because they're expecting to get, $5 billion of tax this year and only $1.4 billion per year after this. So it's not very much tax that they're going to get from this, except that they expect a whole bunch of people will panic and sell quickly. And I don't think they're going to, because remember, it's mostly a tax on real estate, and you can't really sell your property in the 2 months. So now one of the principles of fair tax, is, from the original book, Adam Smith, The Wealth of Nations, was taxes should be predictable. Like people should know what they are, be able to plan for it, know when to pay it and what. And this is like, it's just suddenly that's thrown up. All these doctors or people that have small business owners that have been investing in their corporation, and all of a sudden, we're taxing your retirement portfolio much more highly, and only 2 months notice. And it's also causing a problem for accountants. So we're in the middle of just doing personal taxes and then business taxes June 15th, and they're busy as anything. And now everyone's phoning them saying, I need advice. I don't know, what should I do here? And And it's 2 months just creating this big panic. And we already had this, couple of big debacles that really affected accountants. We had the underused housing tax and the trust debacles just recently. In both cases, people had to file tax new types of returns that they didn't know before, and most people didn't know, and accountants had to do it all for them. It's a whole ton of work, and there's no more tax involved, but there's a big penalty if you don't file it. It's just so the government can get information. But the trust one was a disaster. It was, people were panicking, and hardly anybody knew about the rules. And then the last minute on the deadline, they say, "Oh, don't have to worry about it this year. I don't know about next year. I'll let you know when we get to next year." So I think those have been real disasters and a ton of work for accountants. And a lot of accountants did these things and they can't even charge their client because it turns out, oh, we didn't need to do it. So all that's been going on. And they think, like, why did they do it this way? Like, why did they only give people 2 months? And I think what it is, it's a political ploy. It's hard to understand why they would do it this way any other way. So, and I think what it's trying to do is, it's a wedge issue trying to divide Canadians rich versus poor. Like 2 months, like intentionally piss people off and then create this animosity. And I think that's what it's trying to do. So it really kind of bugs me that it's done this way, retroactive tax with 2 months notice. And the other big thing, the third thing that bugs me is it's an attack on accountants. Like the budget actually said, the rich people have accountants and they can avoid taxes. It makes it sound like accountants are doing something nefarious, and they're not. They're just, telling people what they can do. So I know the accounting associations and most accountants are really offended by the speech, the way it was done. And the issue is income tax is way too complex. It needs to be massively simplified. And the only advantage people have, like accounts aren't that expensive, like most people can afford them. But the thing is, they don't do anything nefarious. It's just that they just know the rules and it's so complex. So those are the things that bug me. Now, why do they say that only 0.13% of Canadians are affected? Because remember, I just showed you, I think it's like 25% of Canadians. So why do they say 0.13? And I think, both of those numbers are probably true at the same time. Now, how do you understand that? So here's why. So first of all, they use 2022 as an issue. And as a year, there's a lot less capital gains than normal. Like it was a big down year for stocks and real estate. So there would have been a lot less capital gains than normal anyway. So most years it wouldn't be 0.13, it'd be 1 or 2% or something. But see, that's how many people are affected in 1 year versus 25% are affected sometime in their life. Okay. Now, the reason this is hard to understand is because people tend to think, oh, there's the wealthy that get this and the poor don't pay it. But that's not actually what happens. So remember, the main people attacked by this is Vinny the tradesperson, right? Either with a rental property. So he sells his property. He's never made much money. He's never had any capital gains, all right? But then 1 year he sells his property, makes $1 million capital gain. He's part of the rich. He's part of the 1%. Right, so he pays the capital gains tax that year, and so he's the mainly one that's attacked. So in any year, he basically never pays it, but he's one of the people that's affected at some point during their life, and that's what actually happens. And to understand this more, you need to understand the difference between the rich and the poor, because there's a lot of talk about rich versus poor, and you know what? I think it's very poorly understand how it actually happens, because people think there's these rich people that are always rich and these poor people that can't get by. And yes, there's a certain number of those, but believe it or not, those are the minority. So mostly, for the most part, and I've seen this from experience, and there's lots of studies that show this, the rich and the poor are the same people in different stages of their life. So the biggest groups of the poor, say the 20% lowest income, the biggest groups are students and seniors, right? So you're a student, you hardly make any money, then you get out of school, you get your first job, it's a starter job, so you're in the second 20% group, right? And over the years, your income goes up as you get more experience and you move to the higher levels. And then most Canadians save hardly anything or not nearly enough, and they retire, they're back in the poor group again. And that's what generally happens. So it's the same people that are the rich and the poor. The high income and the low income are usually the same people. And here's some stats. So 75% of the top 40, so the top 40% of income, 3/4 of them were in the lowest 20% when they were younger. So pretty well, like the bulk of the wealthy people of the above average income used to be the poorest people. So another stat, 88% of the top 1% are there only 1 or 2 years, like Vinny, the tradesperson. That's typical. So the top 1% isn't these billionaires in Norway. I mean, there are some, but hardly any of those. But it's the rich people that are rich all the time. It's not them. It's most of the rich people are the people that are only rich for 1 or 2. They have 2 years. They have one big gain. That's what most of the rich are. So it's the same people. So we got this from a great book, Economic Facts and Fallacies by Thomas Sowell. I've also read a few other books on it, but I highly recommend this one, to kind of understand some of this topic. So last thing is, will this hurt our economy? I think so. So here's how I kind of see it. So first of all, the tax revenue is likely much lower than the 19 billion that they expected. They said it in there. So, and that's because it doesn't take into account what people are going to do. The 19 billion assumes that everybody just keeps doing what they're doing. But when you change the rate, people look at it and think, oh, well, maybe I won't buy that rental property, or maybe I'm just going to hold things. I was going to sell, but you know what? I'm just going to hold it longer. Longer. People do things different. And so it's going to be different from what they expect. And I think they know that. I think it's just politics. I don't think the 19 billion is a real number. I think they just had to put a number in. And the reason is because, 40 or 50 billion of new spending, and it looks dumb to spend all this not getting any money anyway. So they've announced something, probably not going to bring in much revenue. In fact, probably negative revenue total, all things affected. However, it's part of the issue. So it's also, a political wedge issue that may help get some votes. So now, the biggest issue today in the economy is housing unaffordability. And that's been all over the news, and I see it. We have talked to people in their 20s that want to buy a house, and it's like really impossible for most of them. It's very difficult. So, how do you get the down payment, and then how do you qualify for the mortgage? And it's, and part of it is there's such a shortage of real estate, and this is just going to make it worse. So remember, this is a tax mainly on real estate, and what it's going to create is the lock-in effect, right? So it's people that have rental properties that before were thinking I'd sell it, so other people could buy it. Now it's like, I got to pay 67% tax, so I'm just going to hold this thing. And I think there's just going to be fewer, a lower housing supply, fewer houses to buy, and it's going to make things worse, not better, is kind of my view. And I think the $5 billion that they expected, the one-time tax hit from year one from people panicking, I don't think it's going to happen either, because again, it's mostly real estate. You can't really sell your property in that period of time. So, and also, I think the overall tax revenue that the government will get is going to be lower. I think they'll get some tax from this higher capital gains, but they'll be lower in all other areas of the economy slowing down that will more than offset that in tax revenue. It's a taxing all the people that, that grow the economy most. So it's an attack on doctors and other professionals. We already got a shortage of doctors. And now we're attacking their retirement portfolios. And if doctors go to the States, they get 2 or 3 times the income they make here. So it's not that hard to lose doctors. Another one is IT professionals. And the budget is actually trying to promote AI. They got special subsidies for AI, and that's where a lot of the action is now. However, this is they're the ones that have small businesses, or they're the ones that are getting stock options that are going to get nailed by that. So we're specifically nailing the highest growth areas. It's also an attack on small business. That's the main driver of the economy and of jobs. Most jobs are it's more than 95% of all businesses are under 100 people, small businesses. This is where most jobs are. So when you're attacking those people, whatever you tax, you get less of. And then it's attacking the other part that kind of bothers me is the large businesses and the multinationals. Because those, there's no exemption. They're all going to be taxed at this higher rate. And it's easy, and we're not going to buy that Canadian company. We'll just buy a U.S. company instead, right? It's very easy for them to be able to do that, and also to move their executives from a lot of these are multinational. They already have operations in Canada, States, so it's not hard to move their executives, the ones that are getting stock options, over to another country. So we're going to lose a bunch of them. And so here's a couple stats. The question is, how many professionals and employers will leave Canada, and are we going to lose more tax than what this tax gains us? So here's a couple stats. So the top 1% today pay 23% of income tax. So that's almost a quarter is paid by 1% of people. And the top 10% of income earners pay 54% of income. That's more than half is paid by these. So how many of these are we going to lose? If we lose a small percentage of these, then we already lose more tax than we're going to get from this. Remember this, they only think it's going to get 1.4 billion after the first year. So it's not really much tax that they even expect from this. So we'll probably lose more in other places. So anyway, that's why I think it's going to get reversed. I think we're going to see, in retrospect, it's not a good idea. But it's just a political football thing that maybe looks good politics-wise, but not, for financial people. All right, so thank you for listening. So now, just as a summary, what we learned today is, what we covered is, what is the new higher capital gains tax? Who's affected? Why is it mainly a real estate tax? How do you avoid and minimize the higher capital gains tax? Is investing inside your corporation still worthwhile? Will the higher exemption on small business help? Are rental properties or cottages still profitable? Why are only 50 or 67% of capital gains taxed in the first place instead of all gains? What are the three nasty aspects of the new tax that really bug me? Why do they say only 0.13% of Canadians are affected? And will this hurt our economy? So thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner, and it's just edrempel.com or unconventionalwisdom.ca. Remember, we're in Canada, so you got to use .ca. If you're interested in potentially talking to us or working with us, we offer a free 30-minute consultation. There's no pressure. It's just about finding out if we're a fit to work together. And you could find it just by doing edrempel.com/talk. Also, if you subscribe to my blog, podcast, and YouTube, all that means is we'll let you know by email once a month or once a week whenever there's something new out, and you can choose whether or not you want to listen to it or watch it. So my podcast is edrempel.com/listen. YouTube is edrempel.com/watch. Thanks again for listening, and we'll see you next week.